Research continues to show growing investor demand for ESG, but not all ESG tools are created equally. How can market participants improve ESG performance while retaining broad market exposure without sacrificing performance? Hello, I'm Mona Naqvi of S&P Dow Jones Indices, and I'm joined today by Andrew Walsh of UBS Asset Management to discuss recent developments in core ESG, including the S&P 500 ESG Index. Andrew, thanks for joining us today.
My pleasure.
According to some estimates, more than a quarter of all professionally managed assets are now, at least in some way or another, accounting for ESG. But even just a few years ago, this trend wasn't nearly as visible as it is now. Based on what you've seen, Andrew, where do you think this momentum towards sustainable investing is coming from?
It's a very interesting point. I think the key thing is that 10 years ago, I think a lot of investors' mindsets were such that if you invested in a sustainable or ethical way, you had to give up something in terms of performance. I think what we're seeing now is clear evidence through various white papers, academic research, that actually it does not act as a hindrance to your performance. And increasingly, we're even seeing evidence where ESG portfolios are helping to deliver outperformance against their standard parent benchmark index upon which they're built. Just within the ETF space in Europe, we've seen actually 34% growth in ESG ETF growth versus the actual, if you look at the ETF overall excluding ESG, you've got just growth rates of around 7.5 or 8% per annum. So this is a real, you can see the kind of growth trajectory that we're seeing in the ETF space.
Yeah, it's really interesting. You know, I think the space has evolved tremendously over the years. And if you look just back to the days of the early SRI movement, of course, where the approach, I think, was primarily to exclude or screen out sin sectors from a portfolio, which meant having to give up, potentially give up returns through a high level of risk from less diversification. So, you know, kind of fast forward to today, we now have much more nuanced approaches to ESG integration across a whole core of a portfolio. So what does it look like to integrate ESG in the core of a portfolio in terms of the tools that you're offering?
It's really about bringing together a number of key metrics across ESG, the key three ESG pillars. In the case of S&P, we've got about 1,000 possible metrics you could use depending on the overall GIC sector. But really, these are helping to build portfolios with very solid ESG credentials, and yet in some cases outperform. But in the case of the S&P 500 ESG, that in this case is really about replicating exactly what the parent indices is doing, the index is doing, but with an ESG, a very solid ESG overlay.
But fast forward to today, amidst all of this momentum around sustainable investing, it begs the question, how did we get from a relatively small group of ethical-based investors to where we are today?
I think the key thing is just the inexpensiveness of various funds that investors can access now. If you think, say, again, 10, 15 years ago, if you wanted to go about doing this, it was going to cost you a lot of money. You're either going to do individual stock picking yourself, or you'd be buying an active fund, which could easily have had an annual fee of over 1%. Now with the development of passive and ETFs, and we're talking about funds that can cost literally 20, 25 basis points to get access to very in-depth, granular ESG screening profiles. So it really has been, it's sort of this ESG for the masses, really.
Yeah, and you know what, I suppose with the better availability and quality of corporate sustainability performance data as companies are disclosing more, there are now more nuanced approaches to integration so that we can create indices and passive solutions that imply very low cost in terms of tracking error, and that can mirror the returns of the parent benchmark.
In the case of the S&P 500 ESG, that's exactly what's happening here. You've got 25% of the laggards excluded from the parent index, so you're basically ending up with a moderate screen of 75% of the market cap of the S&P 500 parent index, but you're getting almost identical performance. The correlation in returns is basically 0.998, so it's identical to the parent index. The tracking error would be anywhere between 0.6 and 1%, and that's what you want. You want some tracking error. It's doing something a little bit different. You'd expect that. But also, in terms of your returns, you've got a tracking difference over the last 9 years on a per annum basis of 9 basis points per annum, but you've also got about 24 basis points lower volatility, so lower risk that you're getting. Again, increasingly, ESG is also acting as a risk mitigator for portfolios. It can help to avoid some companies that have had major blow-ups across the different E, S, and G pillars.
Absolutely. You know, and I think the other thing that's worth mentioning is that as well as, tracking the parent benchmark as tightly as you so eloquently described, is that we also have a 25% boost in the overall ESG performance. So this is not just about ticking a box around ESG, but actually driving better ESG performance in the companies in the portfolio.
Absolutely, and this is really something that we're seeing now. Again, just to reiterate this point about to invest ethically or through ESG screening does not act as a hindrance to your performance. It's one of the key messages that we really try to convey across to our client base.
So I guess that's really helping us move away from a period where perhaps ESG was something reserved only for the periphery of an investment portfolio, and now really bringing it right into the core of most institutional investors' investments.
Absolutely. And again, this S&P 500 ESG was designed for existing holders of the S&P 500 or other similar types of products to say, well, I want the exact same performance from that underlying parent index, but with an ESG screen. And that's exactly what this is delivering.
Right. So it's not just about any ESG investor or specific ESG allocation. What you're saying is that any investor who uses the S&P 500 can now switch to this version and make good on their values without compromising their investment objectives.
Absolutely right. Absolutely right.
So contrary to what most investors might think, it sounds like ESG investing need not imply a trade-off with returns, with a lot of solutions out there like the S&P 500 ESG. But what really drives this particular index is the quality and the robustness of the underlying data, which accounts for the most financially material and relevant signals within specific industries. How important is it, do you think, to have such an industry-specific approach to ESG?
I think it's absolutely essential. I mean, if you can imagine across the 11 key GIC sectors, whether it's materials or energy, that type of thing, I mean, clearly you wouldn't want one of the key metrics used for materials companies to be used in the IT sector and vice versa. And the great thing about the S&P 500 ESG is there are very clear metrics used across the different industries, and even within subsectors of the key 11 GIC sectors. So it really is essential to ensure that you're basically getting the best companies in the overall 11 key GIC sectors.
So what you're saying is, Andrew, is that by looking at the most industry-specific and material issues within given industries, that allows us to create a product that mirrors the risk and return profile of the parent benchmark, but also allows for a best-in-class approach to ESG based on what's relevant.
Absolutely.
Great. Well, Andrew, thanks very much for joining us. To learn more about ESG, including our recently launched Core ESG family, research and market commentary, visit the link below.